Hilton brings you new ways to stay, with experiences that let you capture the glory days. Introducing the Graduate Hotels. Each inspired by local college towns, these stays are always original and never boring. Get in touch with traditions all across the country and enjoy a stay that's a class above the rest. Book at Graduate Hotels with Hilton Honors Points at Hilton.com. It's a win-win. Hilton, for the stay.
Reality radio for a really great future. We're talking real money.
Hey, welcome to our little show again. I'm Don McDonald, along with Tom Cock, and we're here to talk money. Real money, your life, real life stuff. Making it, saving it, protecting it, spending it, investing it, and not getting ripped off or lied to in the process. And, folks, there's a lot of lying. There's a lot of lying. There's a lot of bad information. There are tons of mistakes made, and that's what the theme of this hour is. The big mistakes. Tom and I have been doing this for a very long time, talking about money with people. I just
figured out. I was thinking about this the other day. Financial journalist, going back to the late 1980s, because that's when I swatched over, had the business radio station, about the same time you started the national show.
1980s.
Yeah.
So wow, we've been at this for a very long time, a combined combined lifetime.
No, or more. Yeah, okay.
Yeah. So we've seen a lot of big mistakes made over those 3.5 decades each, or almost 7 decades when rolled together.
Please. Yeah.
Almost 7 decades. Lots of big mistakes. Lots and lots and lots. And it's hard to decide which is the biggest because there are so many. But I'll tell you what, I'm going to let Tom start with one of those, and we're only going to try and do 5. We might go to 6, depending on how we're feeling.
I've got 5 of my own.
We'll start with one. Start with just one. Give me one.
Here's one.
One.
Biggest mistakes.
Biggest.
Yeah. People generally have a mix of ideas, not a portfolio.
Mix of ideas. I'm writing this down.
They come up with something new comes along. I got to own that, and I add that to my portfolio fund.
Basically, what you're saying is they're just buying a bunch of stuff and they don't have a plan.
Yeah, I think that's true.
They're just hodgepodging their way into the future.
Well, or they trust somebody else to do it for them, and oftentimes those portfolios are horrible hodgepodgery.
Okay, that's a good one. I like that. We're going to put that down. I think the one that resonates with me most, at least right this minute, I'll probably come up with another one later that I think is most, is the tendency among all of us to believe that we know more than the market, that we are smarter than the market, that we're smarter than everybody else, that we have better ideas, that we can predict the future, or that somebody else who's smarter than we are can predict the financial future, and we know that to be absolutely false.
Well, no one knows anything more about the future than you do.
But we think we do. Or we think somebody does. Yeah.
Yeah.
Or we wouldn't be watching CNBC. We would just be ignoring it. Okay, give me another one. I like that one.
My second one is chasing something new or hot.
The latest.
We all get caught up in this.
Yeah, the
FOMO,
latest.
whatever it is, or YOLO, or oh no. I mean, it's always something.
Right.
And we've seen this over and over and over.
We've seen it. We've seen it in the tech stocks in the 90s.
Yeah.
We saw it in the Nifty 50s in the 60s. The Nifty 50s in the 60s.
Yep.
We saw it in real estate in 2006-07. We saw it recently in meme stocks. We've seen it over the past half a decade in crypto flipping currency. Oh, my gosh.
Which is getting more and more publicity every day.
And almost all of it negative.
Not good.
Almost all of it negative. There was a piece in the Washington Post this week about how crypto curmudgeons, they called them, what did they call them? I can't remember the
curmudgeons?
Yeah, the crypto.
Is that who we are?
Yes, we are.
Okay. We're in that club.
We're anti-crypto people. How more and more smart, well-read well-spoken people who understand the market are starting to say the emperor has no clothes. This is a dumb idea that was perpetuated by a bunch of tech geeks who cannot begin to explain it in a way that any human being can understand. So I commented on this article along with hundreds and hundreds of other people. And you could read another one that might open your eyes about a fella, I forget his name now, that got deep into crypto, recommended it to everybody. His firm, by the way, ended up being on both sides of the trade. So when it went straight down, his firm still made money. And somebody just asked him, well, do you feel bad about that? He's like, no, we told you that it was risky. And they've lost most of their money. I mean, it's shocking. So, okay,
something
so
new
chasing
or hot.
what's hot.
What's your number two? Because I know we got to go to a break here in a minute.
I know we're going to go. Okay, no,
okay. Right.
My number two that's hot is not learning from your mistakes, doing the same dumb thing over and over again. Well, I didn't make money in this hot thing, but this friend says this is hot, so I'm going to get into that. We just keep doing the same thing over and over again. We don't learn our lessons.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free, no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch, guaranteed. That's Vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Real money is real life. You need money. None of us are getting through this life without some of it. 855-935-TALK is our phone number, and the more of it you have down the road, the better that life is likely to be. It's not the root of all pleasure or security, but it certainly contributes. 855-935-8255. Give us a call, and Chris, you're up. Welcome to Talking Real Money.
Hey, Chris.
Hello, gentlemen. Hey, thank you very much for taking my call. I enjoy listening to your show every week, so keep up the good work.
Thank you.
The question I have for today is the Social Security. I recently got my statement. I'm about to turn 60, and if I look at that statement, it has an estimate. If I retire at 62, I should be getting about $2,150 a month. How accurate are those statements in real life?
Well, here's the thing. That is based on today's dollars. So Social Security, as you may be aware, is adjusted each year for inflation. And even for next year, they're already saying it may be adjusted upward like 6%. That's one part that will change. The other part will be if you continue to work from now until you start to get it, that could change your benefit a little bit.
A little bit.
Yeah, but I think for remember they look at the 35 highest earning years, I think it is. So again, if it won't be dramatically different than the 2150, but it'll be more. I think we can safely say it'll be more adjusted for inflation.
Yeah, it's a really accurate number based on today's prices. Because it, as Tom said, it's based on such a long earnings history that it would take a huge difference in your life to even change it a few dollars one way or another, because it's an average over such a long period.
It assumes that you will continue to make what you're making today,
correct, until
62, 67, or 70.
So if you drop way down in your pay over that, but it's still only going to be a minor change because of the length of the period. I hope that helps.
I
can't hear you. I'm sorry.
I said I'm sorry. I like the idea of retiring at 62, and my FERS calculator will give me almost $3,000 a month. So I'm thinking I might not have to go to one of those cities you mentioned to earlier.
We're not trying to send anybody away from beautiful Seattle. No, I mean, and it would be tragic, by the way, for you to take Social Security prior to at least full retirement age, because it is extremely costly if you live any more than 10 years after you start to take it.
Yeah,
So
if
it
you
just
have
doesn't
other
make sense.
assets off of which you can live for those intervening 4.5 or 5 years between then and your full retirement age, you're better off doing that probably than taking it early, unless, of course, you think you're somebody who might not live into your late 70s, early 80s. 855-935-TALK is our number. And Lori, you're next. Welcome to the show.
Hello. Good afternoon.
Hi, Lori. How are you?
So I have a question. I'm good. I have a question. My son has inherited about $1.1 million from his father's death, and he already has a Fidelity Roth. He just turned 29, and the advisor there suggested putting it into a Fidelity inheritance or IRA. And I was wondering,
Is this from a retire? I assume this is from an IRA then.
It's half of it is from a pension, the other half is from a 401k plan with his employer.
Yeah, there really is not much choice.
So,
The government is going to require you to open an inherited IRA at Fidelity. Once the money's moved from the current retirement plan to the inherited, then your son could take it to any custodian and have it take care of it or have it managed for him.
Okay, that's why I was wondering if Fidelity, because when we were on the Zoom, we had a meeting, and I asked him if he was 100% fiduciary, and he said he was, but I don't know what the fees are that they charge for handling that inherited IRA.
He probably is a 100% fiduciary at Fidelity, and Fidelity has some very good index passive
we want to make
products.
sure you use those. Yep. Mm-hmm.
We want to make sure you don't use actively managed. A lot of these fiduciaries will still send you into actively managed products, which we would rather you not use. But
Nor your son.
Or your son. But yes, he probably is a fiduciary. Maybe I do know right off the top of my head what Fidelity.
Yeah, Fidelity probably gives a certain amount of leeway to anybody who works there in terms of what they're going to charge you, and by the way, how they may charge you. So they still may use products that have a commission attached to them, even though they call themselves a fiduciary. This is one of the problems with this doggone industry. It's not clear enough. But, so again, from a procedural standpoint, there's no way around the fact that those accounts would have to be opened at Fidelity. But then you could do anything, if your son, by the way, could do anything he wants with that money.
Right. And on
Does that
your
make
guys'
sense?
website, do you have a list of the funds that would be good at Fidelity? I mean, I always hear you mostly talk about Vanguard.
Well, Fidelity is also quite good, and we do have some funds at Fidelity that we like.
Yeah.
But if your son's going to use those, seriously, if he's going to use the funds we have on Talking Real Money, I would suggest that he not pay the advisor. That he doesn't need to. The advisor is not going to provide anything that makes those fees worthwhile unless the advisor is providing fiduciary advice along the way. And if you're just going to pick a couple of great funds and leave them alone for decades,
30 years,
then just put them into those funds at Fidelity. And yes, those are available at talkingrealmoney.com. And
I guess your homework, Lori, would be number one for your son or your son. Find out what the fees would be. Find out what investments they propose. There's no.
You don't have
they should tell you. Here's what we're going to use. That they should tell you that, and then we could help you make an analysis as to whether or not those are, as Don said, passive products or active products. We don't want people using actively managed mutual funds because the track record is pretty clear that they will underperform market indexes.
And thanks so much for the call. Good luck with your son, and we wish him well. He'll sounds like he has a relatively bright financial future ahead of him if he does this right. Well, very
and
bright.
Doesn't spend it.
Very bright. If he doesn't spend this money at his age,
a lot of money in 30 years. Yeah.
Oh, no pressure. No retirement pressure for him at all. 855-935-TALK. That's our phone number, 855-935-8255. And do check out where you can find those funds that we're talking about. If you go to talkingrealmoney.com and you scroll down to popular show topics, you'll see 3 funds at 3 groups. And we have 3 funds at Fidelity, 3 funds at Schwab, 3 funds at Vanguard, and then 3 iShares ETFs, too. to consider if you want to just build your own portfolio.
And at the website, you can. Oh, that's at YouTube, I guess, where you can see Retire Meet again. For those of you looking for something to do this weekend.
YouTube. It's at YouTube.
That's
Our
right.
YouTube channel.
Messed up.
We'll be right back. 855-935-TALK. That's our phone.
Tom and Don are talking real money.
A second opinion could save your life either physically or fiscally. Let one of our Vestory advisors help you save your future at Vestory.com, Vestory.com.
For your real life and real future, Tom and Don are talking real money.
Hi again. I'm Don. Tom's over there. This is Talking Real Money, the radio show on the weekends, the podcast on the weekdays, and this time I'm pretty sure this one's going to be properly recorded and we can turn it into a podcast. Last week's Saturday show is currently on its way to a galaxy far, far away at the speed of light. We hope someone out there enjoys it in the future.
Send it back.
Yeah, it should be a little. Can you just send that signal back to Earth, please?
Yeah.
855-935-TALK is the number to talk about your money stuff. And we're going to do that kind of stuff right now with Vaughn. Hi, Vaughn. Welcome to the show.
Hi, Don. Hi, Tom. How are you guys?
Great. Thanks for calling.
Good. Question. 57. I'm retired. I am working as retired, with my same employer, just not as many hours. I have monthly expenses of $3,000, $2,600 of guaranteed money coming in every month. So as I'm working as a retired casual person, the money I make is enough to cover my monthly expense. I mean, it's enough to cover my monthly expenses plus some. The monthly expenses of $3,000 long term every month, I like to actually have $5,000 a month for traveling and other miscellaneous things and so forth. No debt and so forth. No car payments, house payments. My question is, to me, it seemed like it was a lot easier as you're working and in the accumulation phase of life. You're always hoping for downturns in the market as you continue to put money away. But now at this point in my life, and if I were to decide to stop working as a casual worker with my employer, now I'm in that decumulation phase. Mm-hmm. So now it's a little bit harder for me to understand how to invest in this phase in life. I've always had DTI and, been somewhat aggressive. But now as you get older, it's like you want to preserve but have a little growth. So, but like I said, thankfully in our situation, having the guaranteed monthly income from some pensions and things that covers almost all of our monthly expenses, that's nice. I mean, I'm very fortunate. But I guess I'm trying to figure out the best way to invest. So when I quit working 100% to gain that extra $24,000, $26,000 a year, and we do have approximately $1 million portfolio.
Yeah, I mean, this is always a question. People have a tendency to think there's a dividing line between the time I'm working and the time I'm not working, and my investments should be dramatically different. I don't know that that's great advice. Here's the reason why. Most of us, and it doesn't sound like you need much growth, but most of us need some growth. That growth generally comes from exposing your money to stocks. Stocks are more volatile, certainly have been again this year. So while you go on a base of money that is pretty solid, like the bond part, the other part you'll be trying to get growth because, well, inflation is here, right? And other things are going to make your life more expensive in the future. And if anything unexpected comes along, be it health, etc., you need another pot of money to sort of cover that. So I still, when I counsel people and on the show.
And you counsel lots of people.
Yeah, I talk to a lot of people. You still want to have a decent exposure to stocks, not just, okay, I quit working, I want it all in something that's not going to move around much, but it's not going to make much either. So I would still be looking at a moderate portfolio here, Vaughn, that has a mix of stocks and bonds.
That's why we say this is a very personal decision. it would be nice if there was an accurate rule of thumb. People do tend to glide path their money so that as they get older, it's more conservative. But it's a two-part process, really. The first part is, how much do I need this money to make for me? And I think you've got that number. And then historically, how aggressive did I have to be to get to that number? And in your case, it's not particularly aggressive.
No, I mean, he could be in a portfolio of 50% stocks, 50% bonds, easily draw the 4% a year for a very long period of time, which would be far more than the $2,000 a month you needed.
Right. So, and then the other thing is then determine how much risk you can take, how much volatility you can stand by taking the risk quiz at TalkingRealMoney.com.
Tom and Don are talking real money.
Tom and I created Vestory to help everyone become a better investor, even those who will never be clients. Let one of our advisors help you start your financial plan or solve a money problem free with no obligation or high-pressure sales pitch at Vestory.com. Vestory.com.
Reality radio for a really great future. We're talking real money.
Wow, we have a lot of people calling us. It's great. Thank you. 855-935-TALK is our phone number. I'm Don. Tom's over there. This is Talking Real Money, the place where you can, talk real money with us. Right?
Who would have thought?
Who would have thought? Let's see. Who's next? Oh, looks like Cynthia's up. Hi, Cynthia. Welcome to Talking Real Money.
Hi, thanks. I tuned in late, but did you say do not do actively managed bonds?
Yes.
Or stocks.
Because they're too
Yes.
or stock. Okay. So if so, there's a thing called DODX, DODIX. I'm being asked to go into it. It's managed. They're telling me because the economy is so goofy, it's best to have it managed because we don't know which way it's going to go.
That's the old excuse that, well, if the economy is volatile, then you need to be in an actively managed fund, and that DODX is Dodge and Cox Income Fund.
Yeah.
Yeah.
Mm-hmm.
Yeah.
Yeah. Couple of reasons you don't want to be in. Well, here's the first and biggest reason you don't want to be in an actively managed fund. They cost more than an index fund.
And let's give you the actual cost. Okay, so today you go get your gallon of gas, say it's $5 a gallon. Do you want to go to the one next door where they're charging you $50 a gallon? That's the difference between the Dodge and Cox Income Fund and the Vanguard Total Bond. The Vanguard Total Bond is 4 basis points. The Dodge and Cox Income Fund is 0.42. Mm-hmm. So I try to put this into real dollar. People go, oh, well, I wouldn't pay that much for gas. But if you buy this fund, you are making that exact same judgment.
And here's what happens. Here's what makes this so different, Cynthia. You see, if you bought the Vanguard Total Bond Index, you're going to get all investment grade or better bonds, all high quality paper. So for the Dodge and Cox Fund to compete on yield, they have to, because of those higher fees, they have to put a portion of their fund in junk bonds, in riskier paper. So that's the problem with high fees. And here's the second biggest reason why actively managed funds don't make sense, and that is that no one, I don't care if they're the best manager in the world, no one can predict the financial future. Period.
Okay. You know, I'm kind of disappointed because Schwab is telling me that.
Oh, I'm horribly... that's not surprising.
That's not a surprise. No, not at all.
You got a Schwab advisor who's telling you that, right?
Yes.
Yeah. You shouldn't have Schwab has good and bad advisors.
Yeah, I mean, and again, we don't know this advisor, but in a general sense, you could be at Schwab and not getting 100% fiduciary advice as well.
And we believe, and I think that the law is similar, that if you can put someone in a very similar fund that costs less money, that you are violating your fiduciary responsibility by doing so without giving that person a clear, fundamental money-making reason as to why that makes more sense. And I think that's very difficult to do with Dodge and Cox income, particularly when you consider that not only is it more expensive, but in this past year, because of the additional risk in that portfolio from the junkier bonds, it has done quite a bit worse. Your bonds have all been down, but but the Dodge and Cox, well, not the BND, they're about the same. But it is taking more inherent risk, and that is what bothers me. There's no free lunch out there. If you have a higher expense ratio, then the only way a fund can compete is to take more risk. Am I right?
They have to. Yep. And so please don't fill up at $50 a gallon. That's what I'd say.
Thanks for the call. Do not buy actively managed funds, period. No. Anybody tries to sell you an actively managed fund, they're doing you a disservice, because they also then believe that somebody is smarter than the market, which we know is not true. There is so much evidence. I mean, it is overwhelming evidence that the future can't be predicted. And then add to that, there's just this crazy little thing called common sense.
Tom and Don are talking real money.
Want a free copy of my book, Financial Physics? Well, go download it right now at vestory.com, VESTORY.com.
Your guides to a really great financial future. Tom and Don are talking real money.
There's just not a lot going on in life that is more important than the financial dealings. You get up, you go to work, you spend it, you save it. We hope you invest it. We realize you're going to get some really bad advice. We realize that our advice differs dramatically from the advice of most people, but everything we try to give you, we try to base on science, on real life academic research, not just a hunch. 855-935-TALK is our number. Al, you're next.
I got a question here. My wife have a joint taxable account, and I've got the Vanguard tax managed balanced fund. The symbols are VTMFX. I was just wondering what you guys think of that fund.
Oh, let me have a look. And it's a good fund. It's a 60-40 portfolio. The fees are very reasonable at 9 basis points. 9 basis points.
Gotta love that.
That is just so cheap. You own about 900 stocks, so it leans really heavily toward the S&P 500. 3,000 different bonds. It's a large cap balanced fund.
That's the only criticism I have, is you mainly hold bigger companies. Here's an idea.
Actually, it's about a 50-50. I take that back. It's not 60-40, about 50-50.
Here's an idea. You could keep that. You could add one fund that will give you a little more exposure to small and to value. Don already knows what fund I'm going to say.
You're going to say AVUV, aren't you?
I am, but for the following reason. It's great exposure to U.S. small value. It's extremely tax efficient due to the fact that it's an exchange traded fund, and it has a very low expense ratio. Not as low as this.
But what about VSMAX, though, if he's already, or not VSIAX?
Yeah.
VSIAX, which is the small cap value Admiral shares.
Which is probably cheaper.
And if you did about 10% in that, that's going to bring you to about a 60-40, a true balance split, and you're going to overweight small in value.
Either of those funds, but I tell you what, if you just had it all in the VTMFX, I think you'll be fine.
Oh yeah, exactly. And we're quibbling. We're quibbling. And by the way,
we do.
The Vanguard Small Cap Value Index is 7 basis points.
Wow. I mean, the AVUV is
7. Well, you know what amazes me? And I mentioned this in a recent podcast. The Vanguard Small Cap Value Index is only down about 5% year to date.
Well, U.S. small value, the U.S. small value as an asset class is only down 1.6%.
Right, but you know what's interesting about AVUV?
How bad?
This cracked me up when I saw it the other day. 0.00.
It was flat?
Totally flat.
For the year.
It's lost you nothing. It's made you nothing for the year. Zero.
Which, all things considered, in
That's
2022,
a great year.
That's not a bad thing. That's
Give
not
me
a bad place to
nothing.
be.
Give me nothing.
I'll take it. 0 is good. Yeah. Well, since you raised returns, before we go to Eric, the S&P 500 is down over 13% year to date. A global portfolio.
Yeah.
Balance between big, small value, all those other things down 7.3. About half better. So diversification has helped you.
Yeah. And by the way, the return last year for the AVUV, this just tells you how much more aggressive it can be.
Oh, it is.
It was 42% last year. Vanguard's small cap value, 28. Big difference.
Yeah, I mean, it's more small, and more value orientation. I guarantee those things for sure.
Yep.
So a little more expensive, but probably worth it.
Again, we have time. We've got a line open for you. 855-935-TALK is our phone number. And Eric? Yeah, it's your turn. Hi, Eric.
Hi there. Sorry, I'm driving. I'm cut out a little bit. I heard a recommendation the other day, or read a recommendation the other day from Susie Orman on I-bonds, and I don't know a thing about them. Wondering what you can tell me.
Go ahead, Tom.
Oh,
Go ahead, Tom.
I-bonds.
Go ahead.
Susie. Oh, by the way, Susie has found other ways to buy I-bonds because you can only buy 10,000 per person. But I heard her webinar. I found some other ways to get in.
No, it's only a tax return. That's it.
That's
it's
what
your
she
tax
said.
refund.
Anyway,
No, there's no other way to prove them.
You describe them, I'll hammer them. What's an I-bond,
okay.
Don? Go ahead.
There's no reason to hammer them. They're just
okay. I'll beat them up.
You can only do here's the problem with I-bonds. You can only do $10,000 plus whatever you get in a tax refund up to $5,000 per Social Security number. So
in your house, you could do 20 if you have two of them.
Yeah. She may be talking about the way you can probably buy them if you have a tax ID for something else, but as a rule, for most
but tell
real,
us why
real
so
human
much
beings,
interest in them
there's
today.
so much
They've been
interest
around.
in them. I have them. They've been around for a long time. I got them when the rate was 7. I got my first
now
batch.
It is
a little over 9.
For how long?
Just 6 months.
Yeah, I mean, to me, it feels gimmicky. Like, oh, it's great. I get that for 6 months at $10,000. Okay. Go ahead.
And there's a couple of other downsides.
Yep.
They must be owned for a year. You cannot, for any reason,
Doesn't matter.
cannot cash them out for a year, period. For 5 years, if you take them out, you'll pay a 3-month interest penalty, 3 months worth of the return. Otherwise, they're very safe. They're government guaranteed. In the worst case scenario, their yield will be nothing. Best case scenario, it's whatever the rate of inflation is, but only for a 6-month period.
And here's the other reason I criticize them, because I think they're gimmicky. But here's the other. Remember, for the most part, fixed income should be designed to be used to stabilize your portfolio. Why are so many people interested in I-bonds today? Not for stability, because they're paying 9%.
They're buying it for the yield.
They paid 7%. I want that yield.
I moved money from my bond funds into I-bonds because I know they're stable. They're part of my bond position. They're a tiny part of my bond position, but I like the fact that for the same reason I took some money out and put it into a Marcus savings account, because I was making a little bit more than I was making at my bank.
Okay, how about then why don't you own some of those Ukrainian war bonds that are paying like 25%?
Because there's no safety. You see, U.S. government gives me both safety and a little bit more yield. That's why. Tom's just curmudgeonly.
I think it's just easy to run around and say, just you get your 9%. Yeah,
because it's an easy answer. And I'm not telling people to go out and get them. But if you got $10,000 and it's sitting in a savings account somewhere,
that's another matter. Sure, yeah, okay, that's fair.
No, but
fair.
Susie's always looking for the latest buzzy advice.
Yeah,
buzzworthy advice. And
Susie, general advice is good. When you get into the specifics, then I get nervous. Get out of debt.
General advice is so it's
general.
It's worse than general. It's basic. It's
white bread.
It's duh. It's duh.
Yeah.
It's duh advice.
It is. Yeah, it is.
Her advice and Dave Ramsey's advice is pretty dull. Our advice is only slightly duh. But it is duh when you think about it. You know, if you buy, you put money in more value-oriented assets. Let's see, you're buying undervalued assets. They've done better in the past. Yeah. Duh. You buy small companies. Well, small companies have tended to outgrow large companies. Duh. All the smart advice when it comes to managing money is kind of like a duh thing. We'll be back.
Tom and Don are talking real money.
Is your portfolio a mess? You may have a case of hodgepodgeitis, but don't worry, we can help. Just set up a free no-obligation meeting with a Vestory advisor at Vestory.com. No sales pitch guaranteed. That's Vestory.com.
For your real life and real future, Tom and Don are talking real money.
And if you need a little more detailed help than we can give you here on the show or the podcast, very, very simply, go to Vestory.com. That's our firm, Vestory by Appella, and we'll give you some time with one of our advisors, and that includes Tom from time to time.
Absolutely.
So just to say, he's still there.
Yep.
So set up an appointment by going to Vestory.com. That's Vestory.com. You just scroll down the page to the appointment setting tool, and we will take care of you. No sales pitch, no obligation. Vestory.com.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial product or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?